Hello and welcome to Livewire Markets. My name is Chris Conway. Today I'm joined by Sebastian Mullins, Head of Multi-Asset at Schroders Australia. We're going to be talking about the Schroder Real Return Managed Fund, listed under the ASX ticker GROW. Seb, thanks for being here today.
Thanks for having me, Chris.
Diversification and downside protection appear to be key for your philosophy. Can you explain how they manifest when it comes to GROW?
Sure, we try to make sure that GROW has the same objectives as an individual investor would have. So that is earn a return above inflation. So we have a CPI plus 4 to 5% target over 3 years gross of fees, and try to minimize drawdowns and the frequency of drawdowns to preserve capital. So the way we do that is sort of threefold. First of all, we try and ensure we allocate to asset classes that have the best forward-looking dynamics. So best expected returns, lowest probability of loss. And that gives us a robust portfolio with limited downside and hopefully positive upside. What we then do is ensure that we have diversification within that to ensure that, if one of our bets goes wrong, we have a broad suite of investment ideas to diversify that asset allocation. So you'll see us investing in asset classes like equities, credit, duration, commodities, FX, to give us a broad range of asset classes. And finally, we do a lot of asset allocation ourselves, so very flexible with our asset allocation to make sure we're getting away from potential asset classes that are vulnerable towards asset classes we think are positive. And we also have the ability to put hedges in the portfolio. I mentioned currency already, but even using put options or strategies to protect the downside that might not be available to individual investors.
Seb, why the use of the ETMF structure?
Well, we think for us it's an easy access point for investors. It's a one-click place, so you can buy it on the exchange. There's very limited friction costs there. You can buy it just like you would any other equity. So it's an easy way to gain access to a very well-diversified portfolio managed actively by us. And if you're having a asset allocation, it's very easy to change the asset allocation mix by just buying it on the ASX.
Seb, you brought along a chart to highlight the power of the objective-based approach that you use in GROW. Can you just talk to that for us, please?
Sure. Well, I guess for us, every objective is to maximize return, but the volatility in drawdown is very important. Depending when you have a drawdown or how frequently you have drawdowns can actually affect your overall net wealth as you accumulate over time. So in the graph here, I've shown an example of what happens if over your entire period of accumulation, you earned a 6.5% return per annum, and then 1 year got hit by 15% drawdown. Depending on when that is compared to how close you are to retirement, as you can see, has a massive impact on your total nest egg at retirement. But subsequently, the next chart shows you on the right-hand side that even if your average return is the same over the period, the order of those returns are actually important. So here you can see an investor who's starting to draw down on their nest egg. They have 1 year, 10 years, I should say, that gets 8% per annum. For the next 10 years, 4% per annum, averaging 6. The next investor, exactly the same, but reverse, 4% per annum, then 8% per annum, averaging 6 over the period. But because they're drawing down on their capital, the absolute end outcome is vastly different. So for us, we want to make sure we limit those drawdowns and maximize our return per unit of risk. And you can see here, GROW's drawdown is far lower than both equities and bonds. I draw your attention to the most recent shock in 2022. We were down around 6%, whereas global equities are down 16%, and even bonds were down 11%. So reducing those drawdowns is very important, we think, to limiting that sequencing risk that clients go through.
Seb, how are you currently invested, or how is GROW currently invested, I should say, and what does that say about how you're viewing the world?
Sure. Well, you can see here a pie chart of our current asset allocation. And it's quite well diversified right now between equities, defensive assets, what we call diversifying assets. Those are a mix of higher yielding credits, like high yield, for example, or things like commodities that aren't quite equities and not quite defensive assets. Our cash allocation is quite low, so we do believe assets will outperform cash over the next 3 years. Our equity allocation is around 35% now, give or take. That shows that we're not extremely bullish, but we are pretty fundamentally supportive of equities. If we had a pullback from here, given our all-time highs, we're likely to reinvest probably away from credit into equities and get to around 40-45% allocation.
Seb, can you give us 2 examples of current investments that reflect how you're feeling about the world?
Sure. Well, I guess in that equity components, if you strip out Australian equities and take global equities and compare our holdings to, say, a global equity benchmark, we're currently overweight Japan and the US. So for us, our belief there is the US, we have structural growth. We think that growth story will continue. You have companies that are doing very, very well in terms of their earnings, including the Mag 7. So we think that will be a good place to be. But Japan is still underappreciated and underowned, despite being at all-time highs yet again. That's a structural market where they have structural tailwinds, corporate governance reforms, and it's also one of the few markets that remains cheap today. So that's on equities. And I guess in credits, we do look at things like global credit versus Australian credit. And the spread on Australian credit is far more attractive than global credit. So we've been selling US credit to buy Australian credit. For example, Aussie investment grade credit is compensating you for a recession. So if a recession occurs here, you're being paid for it. Whereas in the US, you're pretty much being compensated for pretty much a normal cycle default rate, which is probably right, but at least the other one in Australia gives you more bang for your buck.
Seb, finally, how would investors use grow in a portfolio?
Well, we think the overall portfolio is attractive to someone in the sort of pre or post-retirement phase, someone who has sort of low tolerance for drawdowns. It's the total portfolio solution for them. But if you mix it with a broader asset allocation, it's actually quite a useful tool to help investors move their asset allocation around without them having to actually trade themselves. So for example, if someone had a 60-40 portfolio, 60% equities, 40% in grow, the movement in grow equities would mean that portfolio would have gone from 66% equities to 76% equities over the last 2 years. So allocating to us gives you, first of all, that dynamic asset allocation without the investor having to trade themselves, but also a broad breadth of opportunities. I mentioned high yield, I mentioned commodities, and we also have structures in that like put options that help protect downside risk that investors might not be able to get to. So it's a nice one-stop shop to get that broad asset allocation and diversification benefit with dynamic asset allocation within a portfolio.
Seb, thanks so much for chatting with Livewire.
Thanks, Chris. Thanks for having me.
If you enjoyed that Fund in Focus, make sure to give it a like and don't forget to follow our YouTube channel because we're adding lots of great content every single week.